This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Good evening, everyone. It is exactly 8 p.m. Eastern Time on this wonderful Monday evening. And it truly is my favorite time of the month where I get to speak with all of you and go over the markets and look at your individual stocks. And for those who are first-timers with the Market Guys, again, welcome. This is an interactive session that will allow you to ask me questions. If you, again, new to the web seminar circuit here, there's a Q&A box that you can type in questions, and eventually when I prompt you, you'll be able to type in a stock symbol, and I'll go through my rapid-fire stock analysis to give you my spin on what I see as far as signals on the chart. Before I get into that content, I'd like to go over a quick review of the markets and compare what's happened today alone, first day of the week, to what I forecasted last Friday. And as I zoom in here, these are the lines that I drew last Friday. And each and every week when I go over my weekly market report, I continue to repeat myself to make sure everyone knows that this isn't some sort of magic trick. That yes, in fact, I do predict the markets. I do it very well. The percentage of accuracy is almost uncanny. And as you'll see, the markets have responded very well to the technical signals, and it is our goal here at the Market Guys to continue to educate you in the art of technical analysis. I call it an art because there is some artistic license that you have to take from time to time, and of course the charts can leave themselves open to interpretation. You just have to make sure that when you are looking at a chart, you try to keep it as simple as possible and not clutter the screen up with all kinds of indicators and oscillators. If you do that, you're going to create too much noise, as we call it, and you'll actually lose the signal in what the charts are trying to tell you. The diamonds is the Dow Jones Industrial Average ETF, again, ticker symbol DIA, and this red candle right there, I'll zoom in a little bit more. Excuse me, I hit the wrong button there. There we go. This red candle right here was what we had on Friday. And as I mentioned in the weekly market report, the shadow, which is that vertical line that protrudes from the bottom of that candle, that long shadow tells us that the buyers on that day were fighting back. That's number one. And number two, as the price was dropping, the volume was dropping. You can see here, my pointer is right on that bar. The volume on that day was lower than what we saw in the volume on Thursday. So I saw that as, again, another buy signal because that tells us the sellers is slowing. On Thursday, we had a big green candle up against this smaller red candle. Who are the experienced chartists? Who can tell me what this two-day signal is right here? This big green candle is called what? Who wants to be the first one to answer that one? Let's see. Drum roll, please. And I know we have a little delay in the feed there. But yeah, Lloyd comes out and says bullish engulfing pattern, and Tom is right behind him, and Caesar and Robert, you're all right, bullish engulfing pattern, which is one of the most accurate buy signals that you will find on the chart. So when I see a bullish engulfing pattern forming on Thursday, and then I see a long shadow under the candle on Friday, which again signals the buyers moving in, I was prompted to draw this diagonal line saying that I thought the markets would bounce. And today, again, Monday, higher, low, higher, high, following right in line with the angle that I drew. Now, let's progress to the spiders, which is SPY. The spiders there as well in the spiders. Now, again, these are different markets. One's more broad-based than the other, but the signal was still there. Thursday, bullish engulfing pattern. Friday, hammer pattern right there, long shadow. And therefore, I drew this line. Now, I'm going to slow down a little bit and give you a little bit more detail in this analysis, which adds to what I gave on the market report on Friday and Saturday. But I only have so many minutes that I can spend on a weekly market report before people start turning it off because it's too long. I have to try to keep that under 6 or 7 minutes, because most people that see my weekly market report are seeing it for the first time, because we do mass emailing to new prospects who are interested in the market. And of course we don't want to overdo it, so we have to limit our content. But here I can dig more into the details and give you the depth in what I'm seeing in the signals. So that hammer pattern is bullish. Bullish signal that follows an extremely bullish signal, boom, I draw my line. The angle here that I drew is basically what I'm forecasting for the rest of this week. And although we sold off towards the end of the day, we might open up a little bit lower tomorrow. Don't take this to the penny on every single forecast. I'm just saying that by the end of the week, I think we're going to go higher, because there's a couple of things that are acting more as magnets for the price action. This gap up here, this is a gap, it's basically a price void, is going to act like a magnet. That's number one. Number two, the distance at which the price has separated itself from the moving average, that's called the divergence, is quite wide. And there's a thing called the rubber band effect that will ultimately draw the price back towards that moving average. So we got the gap above the market, we got the divergence below the market, all acting in concert to bring the price back up. Is it possible the markets could wind up lower? Sure, absolutely. I never tell people I'm 100% right. I'm about 90-something% right, but that's still pretty good. So if you're taking a short-term long position and you know that there's not a 100% chance it'll go up, but a good chance it'll go up, you still have to protect yourself. So if you're buying the spiders or you're buying the diamonds and you think it's going to go up, you're obviously going to buy to sell higher, but you have to still protect below these lows in the event the forecast doesn't go the way you thought it would. But right now, everything looks perfectly fine. Look at Russell 2000. Now again, I'm increasing the broad-based index here is 2,000 stocks versus the S&P 500 stocks. But look what I said. For the Russell 2000, it was a little bit different. I said early on we would most likely move up to test the 20-period moving average, and then I said we would pull back. We might go a little bit higher in the Russell 2000, but I think eventually the Russell is going to pull back. And again, if anyone has any question as to what was said in the weekly market report, just go back and listen to the recording. That's always a good thing to do, because that's actually the hard evidence. I don't ever tell people, oh, this is my percentage, just believe it. I want people to prove it to themselves how accurate technical analysis is. And the only way that you're going to get your belief level to the highest levels possible is to look at the hard evidence. And I document everything, and my partner Bill Shanley documents everything. And to the point where it's like, oh boy, it's almost amazing that prices go almost to the penny sometimes of what we forecast. Now, if you look at the VIX, I'm going to stress this for a moment here. If there is anyone that's watching this web seminar right now who does not have the volatility index listed somewhere on their watch lists, I think you're doing yourself a great disservice, because the VIX is, I'm not going to say the leading indicator, however, it is one of the most important indicators. Volume, believe it or not, being first. Volume is the most important leading indicator. It's not talked about as much as it should, but it is. The VIX is, in my opinion, the second most important leading indicator because it works inversely to the S&P. And my forecast last week was the VIX would drop. Remember, it's inversely related to the S&P. So remember, I said that my forecast was for the S&P to go up. If the S&P goes up, VIX is going to go down. If the VIX goes down, S&P is going to go up. And look what happened. Here is the low that I thought we would reach. Remember, I drew that last Friday. Look at today's low. Unbelievable. It's, again, almost to the penny. Now, again, I want you to keep an eye on this VIX, because as soon as the VIX starts going higher, immediately go to the S&P and start reading those charts. Again, parallel to, as far as how you're looking at it, go look at the VIX. If you have to, open up two charts. I know some of you have trading platforms that allow for two charts to be looked at the same time. If you want to put those side to side, put the VIX right next to the S&P, and you'll see, again, with your own eyes, that the VIX will start to move up before the S&P starts going down. Now, again, you see why this is one of the most important indicators? I mean, you basically have your crystal ball right here, and it is extremely accurate and reliable. I mean, even last week, if you go back a couple of weeks to the market reports that I put out, I said that, and I drew these lines here, these horizontal lines. I said there was a 90% chance that the VIX would fill this gap, and I said that weeks ago. Look what happened. It filled the gap last week. As soon as it filled the gap, it reversed. Boom. Now, why do I think the VIX is going to start to move up? There's actually several reasons. You've got to pay close attention to this, because it goes beyond the technical analysis. Now we're starting to get into cycle theory and economic trends, and again, we're in a major election season right now. All of those things affect price action. And you know, it really, I could dig into the psychological reasons why this happens, but you have to understand that, especially in an election season, when people really see, especially if they start to see the polls very close, uncertainty starts to creep in. And when people feel uncertain or unsure, or there's a lack of commitment, volatility starts going up. And here's why. If people, and think about this as though it was as though you represented the market. Imagine I'm telling you, okay, Paul Farley out there in the Tampa area, I say, Paul, okay, here we are, we're coming into an election season, and I don't know what's going to happen with this election. I don't really know what's going to happen with the economy, but Paul, again, representing the market, says, well, I have all my money in the market right now, and things are looking pretty sketchy, uncertain, untrustworthy. I'm confused. What's Paul going to do? Paul's going to take his stocks and probably sell them in order to get into a safe place. If Paul represents the market, again, the money goes to the sidelines because of the uncertainty. Now, when that happens, volatility increases. Just from the sheer selling pressure, volatility goes up. And the volatility starts to percolate, again, before the price action starts coming in, because it's like a chain reaction. See, now let's expand on this story. With Paul being the market, now there's a group of people who live in Paul's neighborhood now representing the market. Paul takes first step to sell. his neighbors now see him selling. What are his neighbors going to do? Well, Paul's selling. I guess I got to sell. Boom. That adds to the volatility, and the markets start to drop. So again, this forecast that I have for the volatility index, let me get my chart straight here. This price action for the volatility index is not just taking the technical signals into consideration, but also the election cycle and the fact that September and October are usually the most volatile and the most notorious times of the year for down markets. Again, I'm not saying this just off the cuff. I'm just telling you, if you go back over the past 100 years and look at September and October and compare that to the price action, you'll see that there's a large percentage of the time, not even a little bit of a chance, there is a large percent of the sell-offs take place during that time of year. Okay, so that's the VIX. Now, in my weekly market reports, I have not been talking about the Qs, mainly because of time constraints. I'm covering a lot of markets and taking up a lot of time looking at the individual signals. But I thought for tonight I will include this one and give you my spin on this. Now watch. I'm just going to show you what I'm doing here. I'm taking my pencil, see his cursor, and my eye is kind of gravitating to these three highs. Excuse me. So I'm going to take my pencil right there, start the line, and go to the right. And I'm going to connect to the second high point and project out and try to attach as many of these highs as I possibly can. Again, that line is connecting those highs within pennies. And so here we are in the NASDAQ with today's high pulling back again to the penny of that high that I just drew. And what are we seeing today? Who wants to tell me what this two-day signal is right there? I think all the people that answered the first question will probably get this one too. What is the two-day signal? Larry was first to answer, followed by Nathan. And that answer is a bearish engulfing pattern. Bullish engulfing pattern back here, very reliable. See this big, huge bullish engulfing pattern? 80 to 90% of the time, price will go up after a bullish engulfing pattern. What does that say for the NASDAQ? Here's my forecast for the NASDAQ. I think the NASDAQ is actually going to start pulling back before the Dow, S&P, and Russell 2000 pull back. That's what I think is going to happen. And I'm seeing a couple of the major stocks out there. I had one up in the warm-up, PCLN. Some of our option traders have this position. And, like what we just saw in the Qs, price line, that's PCLN, I drew this resistance line for our option traders a while back, because this high, it's hard to see, but that high was drawn also from a bearish engulfing pattern right there. There's a very small bearish engulfing pattern, but right after the bearish engulfing pattern formed on price line, it was a major percentage drop in that stock. So that high represents and still holds as the resistance point. Well, look what happened today. Again, it's not a coincidence. That line, which was drawn weeks and weeks ago, wound up being the high for today's session, exactly on the mark. I mean, not within pennies. It is exactly on that line. And throughout the rest of the day, we started to sell off, and now we have a bearish engulfing pattern. So I don't know how many of you still have an option position in this, or if you're even looking at it, but if I were to forecast on this, it's pretty straightforward for me, because not only do we have the stock pulling back from resistance and we see a bearish engulfing pattern, but we see a drop in volume. Hence the reason for my asking my third question. If a stock is going up but the volume is going down, is that bullish or bearish? Again, who wants to be the first one? Larry, you're leading the charge here. Let's see. Okay. Robert comes in first. beats Nathan by a nose, and all of you are correct when you say it's bearish. When the volume is dropping as the price is going up, that is, the buyers are pulling back on the gas pedal. They're slowing their momentum down, and when the buyers slow down, again, volume is the leading indicator here. It's very, very important. Volume, remember, is the #1 leading indicator. So if price is going up, volume is dropping, watch out below. That's what that means. So there's a very high chance that price line is going to drop. So I'm giving all you option traders a freebie here. If you haven't taken a short call position, I would say a short call spread position, I wouldn't sell naked calls. There's your opportunity to make some more money with a high probability trade and limited risk. So I'll leave it at that. I'm not going to dig into the details because that's what we provide our option alerts for, is to help those people out. Okay, I've taken 20 minutes to go over the markets. My sleeves are now rolled up, and I'm ready to take some questions and or stock symbols, and we will get right into your analysis of your individual stocks, whether they be related to our trade alerts or not. Ron comes out with his first symbol, CSAL. And if I could just add one more thing, if you give me a stock symbol, please tell me what your intentions are, whether you're looking to buy it or you own it already, or you're thinking about shorting it or whatever. For Ron here, you're looking for an entry point, but let me back up a bit, okay? If all of the signals for the general markets, across the board, are showing bearish signs, why are you looking to take a long position? I'm not trying to pin you into a corner, but if you're looking to buy something at this time of year when the markets are turning bearish and the signals are confirming that, you're putting yourself in a high risk position. So with that said, I can see very bearish signals here on CSAL. First of which is this gap right here. The gap was filled on Thursday. That's what this shadow. 80% of the time, there's a rule now. This is an 80-20 rule for gap trading. 80% of the time, the gap will fill. So in this case, it did fill. And the second part of that 80-20 rule is 80% of the time after the gap fills, the price reverses. So there's an 80% chance the stock is going to drop from here now. That's number one. Number two, price is going up, higher high today on lower volume. That's bearish. We have somewhat of a wide divergence here between the moving average and the price. But Ron, this is my forecast for CSAL over the next 4 or 5 trading days. So if you're looking for an entry point, I would suggest that you wait for it to bounce off of a key support level, whether it be the moving average here or this moving average, this low rather. So if the price comes down to $30 and bounces, again, it has to bounce. Don't try to catch the falling knife. We've all heard that before, right? Don't try to catch the falling knife. Wait for it to bounce. Wait for the green candles to form. Wait for some type of an engulfing pattern or a hammer pattern, something bullish, then buy it. And then once you've bought it, you would put your stop somewhere below the key support level. But Ron, right now, it's not looking like a buy signal at all. Okay, so I'm going to go right into, now hopefully there's enough people on this call for me to be able to go for the rest of the time analyzing your stock. So let's go one at a time. They're already stacking up, so I'll just take them in order. Okay. WLL. Now this is coming from Sean, and Sean bought into this today at 7:05. So let's take a look. WLL. And if any of you are dialing in from Canada, I can only take U.S. stocks. And now the thing is, as a coach, I can't help but ask Sean this question. Sean, at what time of day did you buy this stock? I mean, I know your price is at 705, but at what time did you buy it? And the reason I ask you is because today is a red candle. And chances are you bought it maybe, well, actually, from the looks of it, if you bought it at 705, there was never a time after that that it was green, because the top of the candle tells me where the stock opened. Unless, well, from what I can see, the candle was red when you bought it. Okay, so that's you got to watch that one, because the color of the candle is very important. The best time to buy a stock actually is towards the end of the day, so that within the last 15 minutes of the day you can determine whether or not it's going to be green or red. Now, the good thing you got going here, Sean, is that today there's a higher low and a higher high. So that's good. But if you bought it at 705, you have to watch Friday's low, because that low is going to be the critical support level that you would have to watch. Because if it closes below Friday's low, this thing could go a lot lower. So keep an eye on that. And Sean, if I may, where is your stop? Do you have a stop? All right, so you bought it mid-afternoon. Where did you put your stop? Just type that in there so I could help you there. And then secondly, Sean, I'm going to do something that will help you out as well. All right, so your answer to my question is that you have your stop just below the line. Okay, that's good. That's very good. And hopefully you're following the 1% rule, so that if you do get stopped out, you're not going to lose more than 1%. But I just listened to myself there. For those who are brand new, who don't know what the 1% rule is, that's a formula that we use to manage risk. And I have a video on our website that goes into detail about that. And you definitely want to learn about the 1% rules. So if you're brand new and want to learn how to manage risk, go to themarketguys.com, click on the video tab, and in that library you'll see the 1% rule for managing risk. Okay, let's go back to Sean. Sean, this is a weekly chart, and I'm trying to point out the signals as I see them. The good news for you here is that the stock looks as though it's trying to form some sort of bottom. I can't say it's a head and shoulders bottom just yet, but the good news is that it looks like it's trying to go sideways and consolidate. The bad news, and it's not so bad, but it's something you need to pay attention to, is that in July of 2014, a couple of years ago, the stock was trading $90. So I want you to keep this in mind. Those who bought it at 90, those who bought it as it was dropping from 90 and bought it at 60, those who bought it at 40, those who bought it at 20, and those who bought it at 15 are all going to turn into your greatest adversary when it comes to making profit. Because think about this. All of the people who bought it prior to you are losing money. So whenever the stock pops its head above the waterline, these people are going to sell into it to cut their losses. So you got to watch it. That's called overhead resistance. It has nothing to do with the technical signal. It has everything to do with the audience. And what I mean by that is the number of shareholders that are holding on to a loss. They become your greatest enemy, actually. So in best case scenario, I think looking at this weekly chart, I think you would be very happy if you were able to sell it at 15. But I think this stock is going to take a very long time for it to get over 15. So in the meantime, what you're probably going to see is the stock consolidating or trading within this sideways trading channel. That's going to be your opportunity. So if it gets up to $9 and all of a sudden you have a bearish engulfing pattern, sell it. You'll probably get to buy it at 7 again. If you're trailing the stop along the way and it gets up to 11, and then all of a sudden you see an inverted hammer or something bearish, sell it. It'll probably give you another chance to buy it back cheaper. So when traded correctly, this could be a fun stock actually. Just got to keep an eye on that. Just don't let the losses go against you too far, okay? All right, Connie, it's your turn. Now, I just see a stock symbol. So, Connie, if you could just tell me what your idea here is with SYL, I'm going to put that in there. Oh, is that SYL? Is that a Canadian stock, perhaps? It's not Canadian. Is it SYI? Is it SYL? Maybe it's SYI. Maybe I'm just don't have my reading glasses on. Connie, is this yours? SYI? Sinvista Therapeutics? It's not coming up. Okay. All right, Connie, I'm sorry. Maybe you can give me another symbol. If this is a Canadian-based stock, then, again, unfortunately, I'm not going to be able to look at that. I'm going to make an announcement here. It's a little premature, but I'm happy to say my partner Bill Shanley and I have made an agreement with TradeStation, and we're going to be doing webinars through them, and I'll be switching my trading platform here shortly from TD. I'll still use TD from time to time, but TradeStation is going to be my preferred charting for the videos that I do in the weekly market report especially. Okay, Mike says, ready to get long on GDX. Now, the gold index, now this is the weekly chart, Mike. I want you to look at something. Remember, this is weekly. The volume for gold is still relatively high while the price is going down. And 2 weeks ago, we have a bearish engulfing pattern that's still in force. We have not traded higher than that bearish engulfing pattern, so you have to keep that in mind. So I would keep your finger on the trigger, but don't fire that long position off yet until you start seeing more stability in the gold market. So here we go into the daily chart. Now again, look at today's price action. We have prices dropping, but the volume is still maintaining higher levels. We don't see a significant drop in the volume just yet. So what does that mean for Mike? Well, we need to see a drop in the volume first because that's a leading indicator. We need to see some candles that are known to be bullish, whether it be a bullish engulfing pattern, hammer pattern, a harami perhaps. See back here, look at gold is incredible when it comes to the engulfing patterns. This is a bullish engulfing pattern. Look at how it spiked. GDX went from 25 to 29 in just a matter of days here. Look at the haramis. You know what a harami is? Some may not, so let's identify that. Here, right here, is a harami. It's when you have a red candle, a longer body, and then the very next day the green candle has a smaller body that falls within the boundaries of the previous red candle. Harami in Japanese, it translates to pregnant, a pregnant candle. That harami is as bullish as a bullish engulfing pattern. So you can see here the harami played out very well, and then I think we had some bearish engulfing patterns that followed. Well, maybe I'm mistaken. Maybe it's further back. But the dojis at the tops, the long shadows at the top says bearish. So today's red candle does not make me feel all that great about buying. But Mike, the good thing is when you finally do pull the trigger, there's still an unfilled gap above here. There's an unfilled gap in GDX up here. Didn't quite fill that gap. And there's a minor gap still open here. And so those gaps will act as a price magnet eventually. Right now, the 20-period moving average is still going lower. Another idea for you, Mike, is let's say that that you don't know the candle patterns as well as you'd like to know. Again, whether you do or not doesn't matter. I'm just giving you a hypothetical situation. But imagine that you're not relying on the signal. Another easy way to figure out when to get long is when this price closes over the 20-period moving average. That's a 20-period moving average method that Jim Rohrbach introduced to us many years ago on our television show on PBS. So Jim, still alive and kicking. Boy, that man, he's been in the markets for, well, 50 somewhat years, I think, and he waits for the price to close over the moving average before he'll get into it. So you can see that there's a stretch of the price going below the moving average. You might say, I'm going to hold out a little bit and get long when it's over 27, over that moving average. And don't worry about sacrificing the dollar that you think you could get now by getting in early. Just let the confirmation signal play out and put the odds in your favor by going with the signals. Okay, question comes from Caesar. Is it okay if it's a futures symbol? Unfortunately, this is not a futures platform, Caesar. I apologize for that. But if you are looking at anything in the futures markets, understand that the technical signals carry more weight with futures than they do individual stocks. And I do come from the commodities market, so I traded futures in gold, silver, platinum, coffee, sugar, cocoa, orange juice. I traded them all. I even traded the U.S. dollar index when it came on COMEX when we were in the World Trade Center. And technical analysis is critical for any of those markets. All right, Ken, I'm going to go quick. I know I have a lot of people stacking up, and I'm looking at the clock, so I'm going to speed it up just a little bit. USO comes to us here now through Ken Wolf. His question is he's long the January calls at $9. Now, Ken, help me out here. Is that the $9 strike price, or is that the price you paid for calls at another strike price? Either way, I know you're a long call, so you want the price to go. All right, so you long the $9 strike in which January, which month, which year? This coming January or the leaps? Let me help you out here and go a little bit further. Now, for those of you who are not option traders, don't freak out now. This is just a simple Excel spreadsheet, really. That's all it is. So I'm just waiting for, there we go. Okay, so you bought the 2017s, the $9 strike. So let's go right here, the January 2017, $9 strike. They're currently trading 1.5. Okay, for those of you who are not option traders, let me just say this. Ken has bought into a long position. That's, in other words, buying a call, you want the stock to go up. Now you can see here that the stock is trading for around just under $10, but Ken took a long position for a dollar and a half, let's say. So he wants that to go up. And if the price does go up, Ken is in good position to make a sizable profit. So now let's go to the charts and take a look. All right, I like what I see so far. You have a stock that's bouncing off of a key support level here. That's good. You see the price starting to go up with a higher low, higher high today on higher volume. Aha! Remember what I said. The volume is the leading indicator. The fact that we're bouncing with a higher low, higher high, even though that's a red candle, I mean, I don't know. I didn't interrogate Ken long enough to find out if he bought it yesterday or today. So Ken, I'm not going to scold you if you bought it today on the red candle, but I will tell you that now that the stock is starting to pivot up, this fact that the volume is picking up tells us that the buyers are starting to come in. Okay. Would you be inclined to tell me what price you paid for those $9 calls? I might be able to help you out a little bit more and tell you maybe whether or not to put that into a spread of some sort. But again, for the non-option traders, bear with me here. This actually could be fun when you start digging into the option markets. But Ken, if you want to type that in, I know there's a delay in the response for the Q&A box there. But if you okay, you bought the $9 strike 2017, and I don't see a price. Okay. Anyway, so far this looks bullish. Now let me tell you where this could start hit resistance. You have a major resistance point up here around 11. So if you are long those calls and it starts going up to 11 and it starts doing this, so it goes up, hits its head against resistance, start coming down, I would recommend you sell out of the calls, take the profit, and run. And if you're thinking about keeping it a little bit longer, I would at least sell other front month calls against it to turn into a spread. And I think that would be your best bet if ultimately you decide to hold on to it. Okay, so that would be my recommendation to you right there, Ken. All right, now let's go on to David is asking a question. Would you take a bearish position on the spiders this week or wait? I would wait a little bit on that one, mainly because, hold on, let me see. I just lost my my chat box. What happened there? Okay, I would wait on that one because if you look at the spiders, let me get into that here. There we go. Okay. All right. I would wait because I think for the rest of the week, see, I'm going to stick with my original read on the market that the rest of this week it could start to go higher. Okay, all right, David, because once the stock starts bumping its head against that moving average, or let's say it goes a little bit higher and fills the gap, once that happens, all bets are off on the long side, and I'm going ultra short at that particular point. So this is one of those cases where you got to remain patient, and there's two trigger points. Actually, there's three trigger points. Remember, as I said, if it hits the moving average and pulls back, get short. If it goes up a little bit more and fills the gap, short it again. Or the other option would be to wait for a break below 212, which would be a breakout below that support level. Then you could also take another short position because there's a gap below the market in the spiders. So again, it's a wait and see kind of a position that we're in right now. And again, this is like a classic case of sitting on your hands to be patient, because sometimes I've seen so many people try to force a trade before the signal, and then what happens is it moves against them, and now they're debating whether or not to take a loss. And then they take a loss, and then by the time they take the loss, the signal is formed the other way, and it gets crazy, and you start getting what's called whipsawed. You don't want to do that. So again, I'd rather wait for a confirmation signal. And here's another thing I want to give to all of you as a little bit of advice. If you learn how to let the market come to you, the opportunities will be greater than if you're trying to force the trade, number one. But number two, understand that if you do miss a trade, there's always going to be another trade somewhere. Does that make sense? Because there's thousands upon thousands of stocks and ETFs that you can trade, some of which go in line with the Dow, and some are a contrarian or inversely related to the Dow. So there's always going to be a market for you to trade in. And if you could just learn some of the basic, just let's say the engulfing patterns, or a lot of times I teach our students how to just trade the shadows. If you see a long shadow under a candle, buy it. So you look back here. I don't know if you can see my cursor on the spiders. There's a long hammer pattern. Wait for those. You buy on those signals. Put your stop right below the lows and take a little bit of a run. So that would, these are things that you could learn obviously over time, and with experience you'll get really comfortable with them. All right, so let me see, I think I just lost somebody, skipped somebody. Yes, D. McLean, okay, LJPC, want to own it again. All right, let's put that in, LJPC. Oh, typed in the wrong one. LJPC, there we go. A pharmaceutical company. Oh, I would be, oh, you sold for a profit. Okay. All right, here's a good one. Thank you for this. I don't know your complete name, but I see the D there. Thank you, D. I'll call you D for now. All right, here is a great example, and I don't know when you took the profit on this one, but you did the right thing. I often talk about the stale green light or the stale red light. Now let's say that you are in a position where you bought this at 16 and there's 1, 2, 3, 4, 5, 6, 7, 8 green candles in a row with gaps below the market, and there's this wide divergence with long shadows above the candle. That right there is a screaming sale, especially sell for profit. That's a screaming sale. Now, would I take a short position in this? Maybe. Would I be a buyer in the put market if I was an option trader? Absolutely, I would consider buying puts on this. But when would you get back in? So that's the big question. You can't do it now because, look, price is going up. The highs on the volume are going down. Now, let's talk a little bit about this. Again, thank you. This is a great example. This former high back here, you see it went up, pulled back. This peak, this high point right there from August 24th is formerly a resistance area that proved to be just that. It was a resistance area. Sellers came in. But if you've been following along with the market guys long enough, you'll know that when a stock breaks out over resistance, the former resistance turns to support. So there's an 80% chance the gap will fill. And there's another very strong chance that the stock is going to start to gravitate back towards that moving average. Remember the rubber band theory that we talk about. So what I would say is if you're looking to get back into this position, I would wait for the bounce here, right around 20 and right around 19 and a half. And once you get back in on the pullback to that support, you got to wait for that bounce now. Don't try to buy it just because it's right at that line. You got to wait for it to bounce. You got to wait for the green candle. Then I would put my stop somewhere around 18, 18 and a half. And then play it all over again. Now, the pharmaceutical companies are they're very funny. I mean, if you look at Johnson & Johnson, Merck, Eli Lilly, McKesson, you look at all those big heavy hitters, rarely, are they going out of business, unless they're a small startup pharma that's eventually going to be bought out. But this one's been around for a little while. And again, that stale green light tells me it's long overdue for a pullback. Now, second part of this is called 3D charting. It's when I look at a daily chart, but now I take a step back to look at a different time perspective. Ooh, isn't this interesting? And that here is a major resistance line that the stock just got finished pulling back from today. Look at that. It pulled back right from that high already. Now, this is, again, one of these signals, or patterns, I should say, that is very similar to the other stock we looked at, in that this could wind up being a very nice trading channel to profit from. So if we see the stock pulling back, bouncing off of any key support level, you could play with this one for a while, from 15 to 25 almost. That's almost a $10 range. So as an equity trader, it's cheap enough to trade it. If there's options on it, and I'm sure there are, you go to the option markets and you could trade the options on it as well. You could really have a good time with this one. So D, hopefully that helps you out. All right, let's go to Philip. I'm trying to keep up the pace here. You guys are exhausting me here. I'm running out of breath. Okay. Philip says, now this is on Oracle. Let me pull up the stock first, okay, for Philip. Philip says was put 1,500 shares of Oracle at 40 on Friday. Now, again, for the non-option trader, being put the stock means that Philip sold a put and he was assigned a position. So when you sell a put, you're obligating yourself to do what? You're obligating yourself to buy the stock at that strike price. So you bought it at 40. Now, Philip, I imagine you got paid a premium for that, so chances are you're not losing money. If you want to share that with me and tell me how much you sold the puts for, that'll add to the benefit for you. But here's what I would do. This is a weekly chart on Oracle. And notice remember what I said about the Harami? This is a Harami so far on a weekly chart. So that's actually bullish, Philip. That's bullish. Now, if I go to the daily chart, let's see if we get the same read. Okay. Oh, beautiful. I wouldn't do anything with that, Philip. This is a very strong buy signal. That Harami, that's textbook right there. You have a Harami. Remember, stock was going down. Now the volume is going down. The volume today is half of what it was on Friday. So that tells me that the sellers are almost exhausted. So there's a very good chance this one's going to bounce. Here's where I think it could bounce to that gap point. See, here's a small gap. Remember, 80% of the time the gap will fill. So this one could wind up going all the way back up to 40 to 40.10, at which point you have to make a decision. Do you sell for a profit now, or do you do what you're suggesting here and selling the calls against it? Again, that's a tough one because this one might go up and fill that gap and keep going all the way to 40.5. So you got to wait that one out. Here's how I would guide you. Again, this is educational, so take notes. If the stock starts moving up to this gap fill resistance, but you see the volume increasing, hold it. I'll repeat that. If you see the price moving up towards the gap and the volume is increasing, hold it, because that means the buyers are mounting up more momentum, right? If the stock goes up to the gap and the volume starts dropping, choice A, sell for a profit. Choice B, sell the October 40 calls. And I would sell the October 40 calls if the premium is good enough. So now I have to do a little bit more analysis here for you. Again, equity traders, bear with me here. October calls expire in about 4 weeks. And the 40 calls, you know what? I'm looking at that. They're only trading 35 cents right now. Philip, your best choice is if it goes up to fill the gap on lower volume, just sell at a profit and be done with it. Move to cash and look for another trade. There's just not enough premium in there to make it worth your while in holding that position. In other words, they're not giving you enough premium to take the risk. And by the way, your risk is still to the downside, so don't just relax with this position and ignore that. You're probably making a little money right now, maybe not a lot, but you're definitely not losing big on this one, that's for sure. Oh, the other thing I just noticed here, look at this, Philip. This gap has filled. See this gap back here? So on Friday, the gap filled. What's the rule? 80% of chance after 80% of the time after the gap fills, the price will reverse. So that supports my idea that the stock is going to rally from here. Philip, make sure you stay in touch with me because I'd love to see how this plays out for you. You know, I always get a big kick out of finding out the results of the forecast. You know, I don't track every single stock that I comment on. I track every single market that I report on, but not individual stocks like this. So I'd love to stay in touch with you with that. Okay, now George has a good question. If interest rates go up, what happens to precious metals? Well, George, I've been trading the silver and gold markets for 34 years, going on 35. And I got to tell you, I have never seen so much confusion in the precious metals markets than I have recently. Historically, the metals are inversely related to the Dow because interest rates inversely affect the Dow. So if interest rates start going up, that's going to affect the bottom line profits for companies that are being traded by the market. So more cost to carry loans, less profits, lower stock prices. So I'm looking for a big pullback in silver and gold. And I think, and this is just an opinion, so again, take it for what it's worth. My opinion is that we are coming close to a very big shakeup in the markets and the economy. And here's another reason why I think the metals eventually going to go through the roof. How many of you are hearing about these Bitcoin exchanges and what's the other one? cryptocurrency. Have you heard about this? Listen to this. I was in Connecticut and New York this past weekend, and my wife and I have been accumulating gold and silver, in the physical form. And she says, she saw this program on, I don't know if it was a late night television show or whatever, and they're talking about these bills that are laced with actual gold. And I said, stay away. If it's a late night commercial, if something's up there, don't do anything. I'd rather just go with physical gold and silver. But my point to that is, more and more of these companies are popping up, marketing themselves as an alternative currency or a hedge against the US dollar. And that's where I'm most concerned, is I think, and I don't want to get political here, but I have to address this. I am very, very concerned for the U.S. because I don't see any politician, Democrat, Independent, or Republican, I don't see anyone working aggressively to get and move down our debt. We're at $20 trillion, and there's 95 million people out of the workforce. That can't be good. So as a hedge, I'm planning ahead. And I just don't feel comfortable sitting on dollars. Every single penny that I make, I'm either putting it in raw land, or I'm putting it in a precious metal, or another global currency. Even the Canadian dollar, I think, is in better shape than the US dollar. So, think about that. And I'm not saying this to alarm anyone or to scare anyone out of the market, but holy mackerel, if you know that there's an earthquake on the horizon, you can make a lot of money. I'm not talking about a little money here, folks. You could literally make a fortune if you position yourself correctly. That's why I'm trying to shake people out of this idea of just buying for the sake of buying because they've always bought something. If you want to buy something, start looking at the bearish funds. Start looking at inversely related ETFs to the major markets. You don't have to get into the leverage kind. This isn't a recommendation to get you into high risk positions. No, on the contrary, trying to get people to think, hey, watch out below, but don't fear it, embrace it, and make a fortune from it. We're all in a position to do that. So, that's what we do with the market guys. And I try to be as sensible as I can and keep the emotion out. But sometimes it's hard because, you look around at what's going on in this world. Holy mackerel. I'm surprised that after the bombings that took place in New York and New Jersey, that the markets didn't tank today in a big way. I'm shocked that a terrorist attack in New York didn't even affect the market. What does that mean? Does that mean that the investor community is so immune to terrorist attacks or terrorist threats? I hope not. But I tell you, we all need to be very vigilant with regard to how we're handling our money, and do it and manage your money in a conservative way, but absolutely look at the charts so that you can get some insight and look at some of these leading indicators that I talked about. Unfortunately, I'm looking at the clock. I am out of time, and I could see that you're not out of stock symbols. So I think we'll have to carry that on to the next month. Again, if you are a visitor to the Market Guys and this is your first experience with us, welcome. And I certainly welcome you back. If you are still considering subscribing to our alerts, our trade reports and such, go right ahead, go to the Market Guys website and plug in. When we start giving the web seminars for TradeStation, the first one starts on October 20th. Put that in your calendar. I'll be more than happy to alert everyone when that comes up. I think they're doing them from 4:30 to 5:30, so after the market closes. And then I'm doing one on the 27th of October, and then I'm doing another one on October 3rd. Now, they've asked me to design an option boot camp. So if you're not an option trader but would like to learn, at least get your feet wet a little bit, it doesn't cost you anything to plug in. They're all free. And again, we'll put that on our website on the calendar so you can see how to enroll. Again, it's free. Invite your friends, your family. Let's all get together, lock our arms, and look at this market together as a large group and keeping it safe. So, folks, thank you so much. I had a good time giving the presentation today. I hope you had a good time watching it. So have a good night. We'll talk to you soon. So long.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.